Hello, folks. Brandon Chapman with today. It's a Monday video for TheoTrade. It is March 31st, 2025, and boy, we recovered very nicely off our lows. If we look at the S&P 500, you go from low to basically where the high was or where we closed. We almost rallied 2% off the intraday low. And certainly you could get excited by that and think, man, the prospects for the market are tremendous. And it's interesting. You hear people, on X, for example, or elsewhere, talk about generational buying opportunities. Folks, we're talking about a 10% pullback from a market that is significantly overbought, right? I mean, just getting back to averages at the moment, we're kind of settling in around the 200 moving average or below it, and we could have significantly more movement to the downside over the longer term, right? But yes, in the very short term, we are very oversold. And today's move and certainly Friday's sell-off certainly pointed to that. One of the things you could look at on Friday's sell-off is if you look at down volume versus up volume. This is for the New York Stock Exchange. And what you'll see is if we look at volume and I take a ratio of the two, we're looking to see, okay, do we have some sort of like 90% day? We didn't, right? We actually finished around 6. If you look at this yellow line here, we just kind of zoom out on the price. And then, it's here in intraday. If we go to a 1 day, 1 minute, we touched maybe around an 8.5 value up here. If we look at the left-hand scale. So it was definitely a very lopsided day on Monday. If we look at the VIX, the VIX certainly, surged on Monday a fair bit, but ultimately did not get to really big highs and didn't really mark a big sell-off. But we saw previously the VIX went up. There's a lot of hedges that are already on. And if we look at the skew index, you'll also see this reflection as the skew is currently at 139 as of Friday's close. I'm interested to see, do we pull back here? But the S&P finished slightly higher on the session, up 0.75%. And again, the issue right now is that the market's return in the very near term might be relatively balanced. And is that encouraging? I guess so. If we were to think about, okay, in the near term, we might say 590 on the SPY or possibly, 530 on the SPY. The chances of going to 590 or 530 might be relatively equal in the next 30 days. Now, skew doesn't say that. Skew would say that there's more downside risk, but we might see this come back down to a bullish level of about 115 to 120. But I would certainly look at the market and say, look, we've probably balanced out some near-term return potential. And so is it reasonable to look at bullish trades? Sure. Is it reasonable to look at bearish trades? Sure. In the next 30 to 45 days, we could go to 58 and we could go to 54. We could go to 59 and possibly 53. And so trading in both directions does make it possibly reasonable. But to look beyond this point, to consider beyond the next 30 days, the downside indications that are being provided by gold suggest the downside's probably pretty significant. We look at today's best performers, gold's up 1.4%. XLP, consumer staples, up 1.57%. Financials kind of recovering off its low today. There was some significant bearish prints on 326. I traded a downside put spread closing on Friday. Glad I did because I hit my profit expectation of 70%. I closed at an 80% return on my risk. And so, we're seeing the near-term reversal today in XLF. Utilities up towards the top, real estate kind of sliding down as other areas are outperforming. But the point I'm making is this is not exactly a risk-on type scenario when technology, and communications, which carry the biggest weight in the S&P 500, are dragging or holding back the index. And so the bigger picture on this is, what is gold telling us? The COMEX delisting kilo gold contracts for the London Bullion banks, right? The LBMA. They can't deliver gold. It makes sense they'd eliminate or take off or delist those contracts. We're having trouble providing physical gold. There's a discipline in gold. You can't print it out of thin air. We've discounted gold. We suppress gold. If you look at /GC, this is gold futures contracts. In 2023, we finally kind of broke out in my Ghost Prints session on Friday. We're launching a new service on Monday called Ghost Prints. One of those we're looking at kind of background option activity, large prints are one of the factors that are considered in there. And in 2023, right there at the peak of selling, we saw buyers of calls coming in, expecting a breakout in gold and specifically gold stocks. And we finally broke 2000 and didn't look back. But we can certainly look at gold in nominal terms. Okay, this is in dollar terms, but it's also a function of saying gold itself. There is no return on gold long term, right? Any return we see here is because the dollar is going down in value and gold going up. Yeah, there's a paper market in gold. And what's happening right now, that paper market, people are no longer accepting paper to the same level they did previously. They're discounting paper and they want physical. And the best way to take gold is actually positioning it in relationship to the S&P 500. Why? Because we finally get to strip out the dollar's very positive impact on S&P 500 returns. And we start to realize that the actual real return of the S&P is not what it seems. And so we back this out. We go bet max monthly. We look at where this currently stands here, this yellow line. I don't care about the dollar price of the market. What I want to know is, what is the purchasing price? What is the purchasing power of your S&P 500 shares? If I take the current level today, well off the peak of 2000, we'd have to go all the way back. We could go back to 1995, and we're looking at a very similar level for the S&P 500 in terms of its purchasing power. How about that? You're almost 30 years down the road, and your shares in the S&P 500 have not grown in purchasing power, meaning you can't purchase any more stuff today than you could in 1995. Where's the real return in the S&P 500? There is none. It is a mirage, right? We took on a tremendous amount of debt, financialization. We pulled forward a tremendous amount of future appreciation in the market going into the tech bubble of 2000. It was entirely wasted, and we're still dealing with the after effects. How is it that we have all of these companies that don't generate any sort of revenue or free cash flow or operating cash flow? They're not even a going concern, and they consume capital by issuing equity, by issuing debt. We've seen that everything has been financialized, right? We've emphasized consumption over production. Are we finally about to see a shift where real assets, in this case, real money being gold versus fiat money? Fiat money's lifted stocks. So if I look at SPX in dollar terms, I can say, what are you talking about? We're significantly higher today in the 1995. But it is only a mirage because that's how much the dollar's weakened. Your purchasing power of your money's diminished that much. And the S&P 500 has been an abject failure. The idea that we have efficient markets, that we should diversify and buy the good stocks, the bad stocks, and the ugly stocks that make up the S&P 500 or whatever index you want to look at. The idea that that is a winning strategy has ultimately proven to be false in the last 30 years. We continue to point to nominal returns. We don't look at inflation-adjusted returns by using gold's discipline. And your intuition's correct if you're saying, how in the world are companies doing this well when we are carrying this amount of debt? And once you strip out the dollar's effect and its positive boost to the market, you suddenly realize that your intuition was correct. That gold ultimately provides a discipline, right? An understanding of the real return of stocks in the long term. Now, this is not to say there has been great opportunities to buy individual companies. And we might be starting to see the realization that sound fundamental investing actually works. You just got to consider what fundamentals are meaningful for a particular stock, not just a cookie cutter, one size fits all fundamental method. Maybe Benjamin Graham did have something. And guess what? We may be on the verge of seeing a restoration of traditional investing based on income and savings and investment and then production. And again, what we're seeing right now in terms of gold's outperformance is certainly a reflection of that restoration of potential discipline. Now, this is not without risk to gold because there's a mountain of financial products resting on a pinhead, right, of ultimately just assets. The reality is there's not enough assets to cover all of the debt in the world. And if we see a restoration, if we go back to more disciplined markets and disciplined policy, inevitably that does mean the dollar strengthens substantially, as not just the supply of dollars, but the credit that it backs, mark to market, ultimately devalues and the dollar strengthens substantially. And that does mean gold pulls back here. Does it pull back 30%? It absolutely could. Certainly did if we go back to the financial crisis in 2008. But one of the things you can look for in gold is that it does maintain its purchasing power, absent some inanity in terms of policy that disallows us to produce something like at post-COVID, for example. And we look at gold may outperform the S&P 500 and possibly substantially, but it doesn't mean it can't go down in dollar terms. And as we look at all of this stuff in the system, right, that's dependent on the constant expansion in the supply of dollars. If we're looking at Europe right now, starting to see some cracks, for example, in EWG starting to break down a little bit here, right, after its strong run. What happens if we start to see a crisis emerge globally in which demand for dollars picks up? Why would demand for dollars pick up? Because we have a lot of dollar-denominated debt or the world's reserve currency, not necessarily out of strength, but because people are willing to loan us products for our dollars, exchange dollars for goods, and they've basically sat on those dollars. Okay, at what point, and again, a lot of debt is denominated in dollars. And at what point do we start to see a reversion to the mean in that credit creation mechanism? The dollar starts to strengthen as the market really begins to pull back. And that means that gold will pull back as well. But the reason why people are going to physical is they're trying to ensure some degree of purchasing power because that's what gold provides longer term. It is a negative yielding asset in real terms because you got to store it and all this other stuff. What's the role of Bitcoin? Well, we got to take all of the fluff, the paper market out of Bitcoin. Maybe that's what we're doing. And we're finally starting to settle around a price. And maybe it can be a real store of value. Because I'll tell you, if you're looking at dollar-backed cryptocurrencies, right? We're looking at, Tether, that kind of stuff, tethered to securities like treasuries or the dollar. Yes, I get it. It makes it easier for cross-border payments. There might be a solution there, but at the end of the day, what store of value is created by tethering something to the US dollar that over the long term may lose significant amount of value if we're transitioning to more of a gold-backed system where holding physical is meaningful? We'll see. But again, inevitably, Bitcoin, because it is rare, it's divisible, needs all the requirements of money. There's just a very significant paper market that's based on leverage that causes a lot of volatility. At some point, that may work its way out of the system, very similar where gold is today. And that can be a digital form of gold. But stable coins is not the pathway, right? Centralizing digital currencies, centralizing decentralized finance is not the pathway forward. It's going back to what we did previously. We're going to empower banks to be able to engage in the crypto markets. And are they going to engage in a way that enhances the decentralized finance model? No. They're all about centralizing decentralized finance, centralizing risk, etc. And so as we look at this, remember the risks remain in the market. Gold going higher and outperforming is not the bullish sign. But guess what? Yes, you can cheer for today and that we may get a near-term bounce in the market and we may see a nice little surge near-term in stocks. We may see some pickup and leadership in Mag 7 companies, possibly, or we might see a surge in high beta names. But inevitably, again, gold's indication is that the bigger picture is in jeopardy. The financialization of everything is not the pathway forward. It should be based on savings, investment, and production, not consumption and debt only. Well, folks, that's the video for today. We'll catch you back next Monday. You have a great one. Thank you.